Welcome back to my channel. This channel we talk about finance. Today we're going to talk about something everyone's interested in, a balanced portfolio. But first, let's talk about Scott Adams. Do you remember Scott Adams? He was the creator of Dilbert. You remember the nerdy engineer with the pointed-haired boss? Yeah, that one. So Scott had a pretty good quote one time, and I don't remember where I saw this, but it was along the lines of, let me save you a bunch of time meeting with a financial advisor. Here it is. You do 70% in stocks, 30% in bonds. That's it. You're done. Do that every year, and you'll do fabulously. So what's interesting about that is that was, for a long time, great advice. In fact, Vanguard did a great study on this and looked at different portfolio balances, not just over 10 years, not over 20 years, but over about 100 years, as far back as they could go, in different bond funds and different stock funds. So I'm going to go through part of that today, and I think it'll be interesting because one question that I have and why I wanted to talk about this was, in a world with negative interest rates in some countries and zero interest rates almost in the United States, what does that mean for someone with a balanced portfolio? Is it still good advice? So I've linked the Vanguard research in the show notes. And what's great about this, as you take a look through it, is it breaks things down into three categories: income, balanced, and growth. And I'll go through those here in a second. Income, and I'll just read what they say, is for an investor who seeks current income with minimal risk to principal and is comfortable with only modest long-term growth. So on here they've got 100% bonds, and then they're showing the annual return from 1926 to 2018, so just 2 years ago, and it's a 5.3% return. So over that near 100 years, it was 5.3% annualized. And this is really set up for someone who's looking at income. So they gave it the title of income. Think retirees, think someone who is very unwilling to risk their principal in any way, shape, and form. And then they go into like, okay, a split of 30% stocks to 70% bonds jumps from 5.3% to 7.1% return annualized. So quite a jump just going to 30% stocks. You see almost a 2% improvement in return. And then it gets into what they call a balanced investor, and that's someone who's looking for income and has a slightly longer time horizon. So they're willing to put up with some of the short-term vicissitudes, as Charlie Munger likes to call it, and price fluctuation, and has a mid to long-term investment time horizon. So this isn't a retiree. This is someone that is maybe in the middle of their career and is looking at holding what they have, but still seeing some upside. So the average annual return at the start here is a 40% stock, 60% bond. That's a 7.7% return, all the way up to 60% stocks and 40% bonds, has jumped all the way to 8.6% annualized. So doing nothing but sticking all of your money and rebalancing it every January 1st, 60% stocks, 40% bonds, 8.6% return for the last 100 years. And then they go into growth, which is basically an investor who's really just looking at the long term. They really care about the growth of the principal and is willing to potentially tolerate large fluctuations. So the 2008 recession, the coronavirus, big 50%, 40% swings in the underlying value of their security. So in this case, the best year was 41% in 1933, the worst year was negative 30% for a 70% stock, 30% bonds. But annualized, it was 9.1%. And 100% stock jumps you to 10.1%, but it also comes at a cost. Because your worst year, you saw everything go down, your entire portfolio went down 43%. Now, in your best year, it went up 50. So what this does is gives you a nice window into a long time horizon. But the question to really ask here is, does what happened in 1931 matter versus today? What we've seen happen in the last 10 years and 12 years might be wildly different than what they saw in 1950. So let's take a look at today. Let's take a look at the return for Treasury bills over the last 50, 60 years and see how those did. And why I think that's important is because the rates aren't always constant. Here's an example where you can clearly see from 1960, the rates were from the Fed were at about 4%, and not that far removed from what they were in the early 2000s for the US, or even the 90s. They jumped way up to around 20% in 1980, the height of the gasoline shortage here in the US, and then slowly and steadily have gone down, down, down through the 90s, through the 2000s, and are now hovering near zero. They started to creep back up in 2020. They went to the floor again as the world braced for a global pandemic. The argument I would make is that rates are going to stay low. That for the next 10, 15, maybe even 20 years, the rates are not going to escalate much higher without large structural changes. Every politician that comes from here forward is going to be under immense pressure to show results with the economy. And one lever that is consistently getting pulled right now and will probably get pulled for the future is to lower rates and try to spur more growth. With that in mind, what if for the next 20, 30 years, the rates stay almost at zero? What if they go negative? And we've never seen that as a country. How will that affect a balanced portfolio? One way we might tell if low rates that you're going to get from bonds are going to negatively impact future returns would be, well, let's look in the recent history. Let's see for the last 10, 15 years, what kind of a difference those low yielding bonds might have given us. Here is an easy way to visualize the portfolio difference and backtest on portfoliovisualizer.com. We're going to do year to year from 2005 to 2020. We're going to start with $10,000 with no more cash flow, so we're not going to put any more money into this fund. We're going to rebalance it annually. And then we're going to do a few different portfolios. Portfolio 1 is just going to be in the total stock market fund from Vanguard. So VTSAX, 100% for Portfolio 1. Portfolio 2 is going to be Vanguard Bond Total Fund, so VBTLX. And it's going to be a mix, so 70% of the total stock fund and 30% of the total bond fund from Vanguard. And then the last portfolio, Portfolio 3, is going to be a mix of 70% in the total stock fund again. And instead of the total bond fund, we're going to use the Vanguard long-term U.S. Treasuries. Let's see how they do. If we jump into the actual final balance, so Portfolio 1, 100% stocks, $35,787. Portfolio 2, $31,515. Portfolio 3, this was the U.S. Treasuries, $37,607. So you can see here that amazingly, even with the low rates that the Treasuries are yielding over the last 10, 15 years, having a portfolio with 70% of stocks and 30% US Treasuries yields the highest. It's yielding 8.92% versus 100% of stocks. Even with Amazon, Microsoft, Apple, everything in there, it's yielding 8.57, and the portfolio 2 yields the least at 31,515. But how can that be? Why is it that a portfolio of all stocks that have done well relatively over the last 10 years is outperformed by a portfolio that has a mixture of stocks and US Treasuries? Because US Treasuries have not been, if we go back and look at this other chart, US Treasuries have not been doing well over the last 10 years. It's not like they're this big boom that is yielding a high percentage. So why is it? And the reason is because the US Treasuries are a good store and they act as a ballast. So that means you don't get quite as high as return typically over the long run, but it also means you don't see those deep valleys because you've got something holding you up. There's no chance that the US government is going to default on its debt. So the treasuries are going to be yielding whatever the coupon rate is on the bond, but not so for the stocks. They will go down, they will go back up, they will go down again. And one thing that treasuries help do is offset some of that fluctuation and keep things moving steadily up. So the answer to the question is, will U.S. Treasuries' low rates and the Fed's low rate affect the good, sound portfolio advice of 70 to 80% stocks and 20 to 30% bonds for a long-term investor? And the answer is no. It won't impact it. Now, I personally think there is a caveat here. I think that it is great advice. For me personally, for things like a 401k, where I know this is an investment that's going to be growing over 30, 40 years. 40 years is a long time. So even that 1%, I want to make sure I get. So I'm 100% stocks in my 401k. I'm not doing any bonds. I'm like in it for the long run. Let it grow. Let it keep growing. If it goes down, that's okay. I'm buying more every month. That's part of the deal with the 401k. You buy it when it's low, you buy it when it's high, you buy it. Just keep on buying. It's that time in the market over the very long term. But I think it's good to note, even for like brokerage accounts, for things where you're just trying to figure out, it's helpful to me to see that sound advice really can be have 20%, 30% in bonds and help keep that portfolio level over the near term, the midterm time horizon to short term. I hope that was helpful. If it's helpful for you, I invite you to subscribe. I'll keep doing videos like this. If you have a portfolio you think is a good mixture in your 401k and why you've gone with it, why don't you leave a comment down below, and I'll look forward to seeing you again next time.